Hello and welcome. Today we're going to talk about things that you should know before you look to getting more money for your business, also known as working capital. Every entrepreneur knows that working capital is the lifeblood of any business. And so this episode is very important, especially if you're just starting out and wondering how are you going to get from where you are to where you want to be. And it can be a fun and exciting road, but you got to keep these tips in mind before you begin so that you're not doing it haphazardly or that you're doing it wrong, wasting time trying to get capital you don't need or doing it the wrong way and hurting your overall business. Before we begin, if you're new here, my name is Taylor Darcy from Think Legal, where I help you create the business of your dreams. So welcome. I'm happy to have you here watching. Hopefully you'll join me. I go live every weekday except for holidays, Monday through Friday at 11 a.m. And we discuss the things that are relevant to your business, the things that you can hurt you, but also more to the point, things that we can do to help you. Don't forget, I also have a podcast that is published weekly on Thursdays. And the links are below, so feel free to join and listen to that. The content is different than what you'll see on the daily videos, so keep that in mind that you're going to get different types of tips and ideas in the podcast. Now, there are episodes of the podcast on here because it is a video podcast, but it's not the same day-to-day things that help your business the same way. Let's get started. First of all, and this is very important from a legal perspective, make sure that you're getting your legal affairs in order before you're, this has got to be at the very beginning, but before you're even considering raising capital. And the reason for it is different entities allow you to do different things, such as a sole proprietor only really allows you to get debt security. There's only really one way to get equity, and that's by having a business entity. You can't get that by having just a sole proprietor because people can't buy stocks of you unless you incorporate or unless you're a membership interest in an LLC. So keep those things in mind that this has to do with being able to get equity outside of the normal you own everything. So number one, you want to make sure your business entity is correct. Now, typically, I recommend either an LLC or an S corporation, depending on what your objective is and your end goal, which is why it's so important that you speak with an attorney, or any other type of person that can advise you regarding what type of business entity. The internet really doesn't know what your goals are, and so sometimes what they'll do is they'll tell you the wrong thing, and it could have long-lasting consequences, or where to form it could have long-lasting consequences. Next thing that you're going to want to do is make sure that your contracts are in order, that are coincide. So because that's part of the benefit of having an entity is that the contracts are in the entity's name, and that's part of the value of the corporation or LLC, depending on your entity choice. So you want to make sure that you've got your contracts that are right, that are in order, that are not in your personal name, that are in the company name, because that all goes into the due diligence that's going to happen in the equity getting process. So those are your number ones. Get your legal house in order. Make sure that you've got everything taken care of contractually, business licenses. Make sure that there's nothing outstanding that you still need to do. If you have insurance that you need to get taken care of, then make sure that you've got your insurance covering you. So that when you're doing your due diligence and the other party's doing their due diligence, you've got everything already set out. Now, this is several steps down the road, so I don't want you to think this is going to happen immediately. But the overall point is by starting with this in mind, you're going to be a lot more successful long-term than you are if you try to do it haphazardly or without any type of direction. So that's number one. Number two, get your financial house in order. So that means you want to make sure that you're on top of your financials, your profit and loss, your income statement, your accounts receivable. All of these things are going to play into your equity and what you're going to need. Also, another great thing to have is a cash flow analysis so that you can show what your need is going to be long term so that you can estimate properly for the amount of growth that you're looking for. This is crucial because having a cash flow statement, cash flow projections will allow you to estimate to the best of your ability, right, that you'll need additional influx of cash at year 2, month 5. Okay, I'm just using that as for instance. And that gives you a lot clearer goal towards getting that equity at that point, rather than, oh man, we need money. And then it hurts you, because the worst possible time to get money is when you need money. I know that's funny, but investors don't like to see that type of thing. They want to see that you've planned for it and you're moving forward in that type of direction. So keep that type of thing in mind as you're going for it. So you really want, again, to have your P&L, your income statement, and your accounts receivables, see what people are outstanding, what debts or what obligations are outstanding to you. Okay. Next, you're going to want to make sure that you are updating, improving your business plan. You want to make your business plan successful through preparation, which is what we've been talking about here, presentation, and sizzle. Your business plan should not just be boring. The investors see boring all the time. And the last thing you want to do is bore the crap out of your investors. You need your business plan to draw attention. The idea, and we talked about this in a previous episode, you want to have a single-page business plan, a 2-page business plan, and then the full Monty business plan where it goes in great depth. And really, each thing is to get you to the next one. So if you're interesting in your first one, then it's going to get people to your 2-page, and then from your 2-page to your full one. It's about respecting the time of the potential investor, because they are typically very, very busy people. And when you look at it from their perspective, if you have to read through a 40-page, 50, 100, 250-page business plan, most likely that's going to go to the bottom of the pile, especially if it's kind of sort of maybe interesting. So by giving your interesting page first, the sizzle, right, then you're going to improve people's desire to give you their attention. And this really just has to do with respecting their time and their whatnot. But also, everybody has a short attention span these days. That's just how it is. There's no getting around that. So the idea being that you want to give them just a taste, right? That they've seen, like, for instance, in grocery stores. In grocery stores, they've seen huge spikes in sales as they offered samples. Because now all of a sudden you got a taste and you found that you liked it or didn't like it. And so people that liked it would buy more of that particular product. And that's why they offer samples. So think of that in the context of your business plan and getting investors. You want to whet their appetite. You want to give them a little bit something there to give them just a taste of what you're offering them, right? And so that's what you have to keep looking at from your business plan perspective. Your single page, your 2-page, and then your full report. Just give them just that little something. Now, another thing that you want to make sure is don't wait until it's too late. The worst possible time to get or try to get capital for your business is when you need it. And the reason why is because then it puts you in a bad situation for a couple of reasons. Number one, you're bugging investors when they're busy and they may not have time for you. And then 2, you're putting yourself in a situation where they can leverage that against you. So they're going to make you give them more of your business for the amount that they're investing. And so it really can hurt you in that respect, because otherwise they smell the proverbial blood in the water, right? And so you don't want to put yourself in that situation, which is why planning and being specific about your needs is so very important. You want to make sure that they're getting in and it's the least cost of capital possible for you, not for them, right? They're wanting the most, which is why it's advantageous for you to wait in that respect, but it can also turn them off because now they're getting something that their risk is increased, versus if you don't need it at that moment and you've projected it into the future, then you're going to get the best deal and you're going to get the investor, because they're paying attention a lot to how you're managing your money and your business. And so the idea being that if you can manage it correctly, where you've got these projections and the financials to back things up, then you can show them, hey, I've got what you need, I've got what you want, invest with me and you're going to get what you want. And that brings me to the last point that goes with this. You got to keep in mind throughout this entire process, what is in it for them. That is the key. That is the absolute thing you should always focus on when it comes to getting investors. What is in it for them? The more you focus on that, the more successful you'll be with investors. And you'll also be able to hone your message to get to the right investor. Remember, we were talking about don't wait. Well, that's part of this process, is you want to get the right investor, not just a investor. And so that makes a big difference when you're focusing on what's in it for them as opposed to what's in it for you. Because when they feel like that, if you're only looking out for your interest, that's obvious. You're going to look out for your interest. The goal though is to make sure that you're putting their needs in there first, right? Like, what's the exit strategy? And we'll talk more about these in future episodes, but just keep this in mind, that you really want to make sure you're focusing on what's in it for them. If you've gotten value out of this video, please don't forget to hit subscribe and like. We go live every weekday, Monday through Friday, except for holidays. Have a good one.